If you had $1 million, $2 million, or even $10 million saved for retirement, how would you invest it? If you think today's wealthy retirees are stashing their money in cash at the bank or in CDs, then think again. In today's video, we'll talk about how wealthy retirees are investing in 2026. The reality is that many retirees today are investing differently than they did even 10 years ago. In fact, a lot of the biggest trends that I'm noticing have very little to do with stock picking and more to do with generating income, protecting your income against inflation, and investing in a tax-efficient way. Now, before we really begin, I want to be clear that this is not investment advice. This is not a recommendation. This is purely for educational purposes. Talk to your own advisor and your tax professional if you have questions about how your own situation applies. And of course, every investor's situation is a little different. So that's what we'll get into today. My name is Travis. Welcome back to the channel. I know it's been a while. I am a financial advisor and part of the ownership of Andrews Advisory Associates, which is a wealth management firm in Honolulu, Hawaii. Our specialty is in helping retirees make smart decisions with their retirement money, especially with generating income, their investments, and tax planning. When I refer to wealthy retirees, I'm generally talking about people that have at least $1 million in investable assets. We do see people that have more than that, $5 million, $10 million, but there's usually a minimum amount of money that you need to do some of the investment ideas that we'll talk about, especially in regards to taxes, where it makes more sense once you have a higher amount of investable money. Today, we'll look at some of the investing trends for retirees that are shaping how portfolios are constructed. And there's three. The third trend that I'll go over may be the most valuable because it has a real benefit to retirees beyond just picking better investments. So we'll get to that in our third point. Now, the first point about how wealthy retirees are investing has to do with keeping less in cash or cash equivalents and investing in more income-producing assets. So traditionally, you might have retirees who keep a large amount of cash in the bank. And for the last couple of years, that may not have been a bad idea. Savings, high yield savings accounts, and other types of high interest rate accounts were paying decent rates of income, upwards of 4 to even 5% for not taking on any risk, keeping your money at the bank. Those rates have changed. And now we're not getting 4 to 5% from a high yield savings account anymore. Now, anywhere between 3 to 4% is more realistic. Some people still keep a little bit of money in cash, but a lot of retirees shifted into fixed income and income producing assets. And income producing assets doesn't necessarily mean they're ramping up the risk on their portfolio, but they might be looking at things like municipal bonds or short and intermediate term bonds. They're taking on a little bit more risk, a little bit more interest rate risk, with the return being a slightly higher income for their money. I've also seen retirees put more of their money into municipal bonds, especially for high income earners. With municipal bonds, you have the tax benefit of not needing to pay federal income tax on the income. And if you buy state-specific muni bonds and you reside in that state, you may also have a state tax benefit. So if you're in the highest federal tax brackets, then it may be worth it to look at municipal bonds because they can get a better tax-adjusted rate of income. Another shift we've been seeing is into dividend-paying stocks. Besides investing in bonds, which pay out a coupon, certain stocks also pay a dividend. And retirees have been looking at stocks that grow their dividend consistently. Not always about what pays the highest dividend, but sometimes it's about what pays a consistently growing dividend. So that's been a popular option. Retirees moving into dividend-focused funds and stocks. And finally, alternatives. Alternatives such as real estate investment trusts have really taken off. Some people have shifted into private credit, into private debt, but the real estate investment trust option has been very attractive, especially if the REIT is able to pass along depreciation to the shareholders, making quite a bit of the income, the current income, not taxable if they're able to do that. The second trend that we're seeing is retirees maintaining high equity exposure due to longer life expectancy. People are living longer. So it's not simple as soon as you retire, selling all of your stocks and moving it all to cash. Because of longer life expectancies now, you need to have a portfolio that continues to grow even throughout the first few decades of your retirement. Some retirees take it a step further and maintain a growth tilt in their portfolio, meaning that one of their objectives is not only to maintain their purchasing power and generate income, they also want to see that portfolio grow over time. If you have a desire to leave a legacy, then that becomes an attractive option. The big risk with retirement is inflation. Your purchasing power getting less and less every year because everything's getting more expensive. There's no telling what inflation does in the future. We know that in general, inflation causes prices to go up over time at different rates. So having your portfolio be able to sustain an income that also goes up over time is important to keep up with inflation. Some people follow a bucket strategy, which means that you have 3 buckets and your portfolio is segmented into each of these 3 buckets. I've written some blogs about this topic in the past. Essentially what it is you segment your retirement portfolio into time horizons. So you have a short-term bucket where you keep cash and low-risk assets. This is the money that you might need to be spending in the next 1 to 3 years. You don't want to have it subject to very much stock market risk because you need it to be there when you want to take it out of that portfolio. That's one bucket. The second bucket would be for intermediate time horizon needs. If you know you have spending needs in the next 5 to 10 years, then you'll keep that bucket full of assets that have the potential to grow, but limiting the downside risk because you know in 5 to 10 years, you'll want to be spending that money. And then the third bucket is going to be your long-term investments. This is where the equities go. This is where you can afford to take a little bit more stock risk for the trade-off of having higher returns. So the 3-bucket strategy is very common and popular for retirees to follow. Overall, this trend is showing retirees maintaining strong equity exposure, not jumping all into bonds immediately upon retiring. They're maintaining a diversified portfolio. They're maintaining some growth tilt in their portfolio to get higher returns, and they're segmenting their portfolio into different buckets where you have a short-term, intermediate term, and a long-term, all in the name of combating inflation and not letting your purchasing power deteriorate throughout your retirement, because life expectancies have gone up over time. So if you need to sustain a 30 to 35 plus year retirement, you need to have the assets continue to grow to be able to have the money generating an income for you. And the third trend here is we see a big focus on tax efficiency. Why? Why is this important? Now, going back to the beginning, the intro, I said this is maybe the most valuable of the 3 ways that retirees are investing. They're investing with taxes in mind. Taxes can be one of the unexpected and most significant costs in retirement. People can plan for their daily living expenses. You can plan for your mortgage being paid, but taxes can be variable. Tax rates could change in the future. And a lot of people aren't really sure when the year starts what they're going to be paying in taxes, especially in retirement, where you're not having your taxes withheld from your paycheck like you are when you're working. So taxes can be a big deal. And it's something that a lot of wealthy retirees plan for. Different ways that they do this, right? One way is focusing on the strategy of it and the tax planning, doing Roth conversions. So they're paying taxes at their current rate with the expectation that in the future, they'll be in a higher tax rate where they won't have to pay taxes on money that's been converted to Roth. Other ways that retirees approach this is by setting their asset location strategy. So if you have different types of accounts, maybe you have a pre-tax account like an IRA that you haven't paid taxes on yet, you have your Roth account that you've already paid taxes on, and then you have your taxable brokerage account. Each of those 3 accounts handles taxes in a different way. And so choosing what investments belong in which account can save you a significant amount of taxes each year, and added up over your lifetime can be a really meaningful exercise. Other ways that retirees are managing this is in managing Medicare costs. So once you turn 65 and you're enrolled in Medicare, you may have what's called IRMA, to be careful of, which is an income threshold. And if you go over that threshold, then your Part B and Part D Medicare expenses could increase. This is a little complicated, and we've written about this as well on our website, but it has to be handled properly so that you're not unknowingly increasing income and then paying more in Medicare Part B and Part D. So advisors now, and I speak for other advisors, but certainly for our firm, we view tax efficiency as just as important as investment selection. Tax efficiency is looked at as one of the first things when you're building a portfolio, because there's a lot of tangible value that you can get from good tax planning. There's a lot of value in choosing the right investments and in choosing the right location to hold those investments in. As far as investment selection, we've been talking to a lot of clients about direct indexing, where in your brokerage accounts, you have the ability to harvest tax losses if your investments go down in value. And direct indexing allows you to own shares directly of many, many different investments. And when they go down in value, they can be sold, realizing that tax loss, but then immediately using the proceeds to buy a similar investment, not the same, but a similar investment, so that you can maintain your exposure in the stock market while capturing that tax loss. And so that allows you to bank these tax losses. If you're a high income household, you can use those tax losses to offset any upcoming capital gains that you might have, or you can use up to $3,000 of it to offset your ordinary income every year. So it ends up being a pretty worthwhile thing to look at for most people in a high income tax bracket, or if you're expecting to generate or realize a capital gain in the future. Let's say you're looking to sell your home or sell your investment property, then that could be a good time to offset those future gains if you have a bank of realized losses. So to conclude this video, the 3 points and the 3 ways we see retirees investing in 2026 is, number one, they're focusing not on picking stocks and not on holding cash, but on generating income from their portfolio. So instead of keeping a bunch of money in the bank or in CDs, they're turning that into tax efficient investments and generating sustainable income out of that cash. Often we see that used through bonds, municipal bonds, real estate investment trusts, and dividend-paying stocks. Number 2, they are focusing on inflation protection. So rather than keeping all of their money in cash, they're maintaining a healthy amount of equities in the portfolio. The main risk that people are trying to protect against is inflation. So we all know the price of everything increases. Some things go up by more than others. So it's important to have a portfolio that is also growing as you age, so that you're not just hit with high prices without your portfolio able to pay for that. And the third thing is in managing taxes. So with taxes and tax efficient investing, this is one of the levers that we can look at where it makes a big difference. By investing in the right types of accounts and in the right types of investments, you can lower your tax bill, and it's something that you can do every year and optimize every year to lower your taxes overall. So if you're retired or you're planning to retire in the next 5 years, the question isn't about what stock should I buy or what bond should I buy. It's more about, how do I coordinate all of this into a retirement strategy? How do I generate an income from my assets? And what sort of tax planning do I need to be doing now so I'm not hit with a bigger tax bill than I need to be paying later? As always, if you would like a second opinion on your retirement strategy, we offer a complimentary look at that on your investment portfolio, on your taxes, and how it all coordinates with your retirement income strategy. Contact us on our website. We'll be happy to have a phone call with you. And really, it's just a good way to get a handle on whether you're prepared and give you some peace of mind. That's all for today. See you next time.